So you think that £20,000 ISA limit is a hard wall you can never get past? Well, what if I told you there were hidden doors you could walk right through, legally boosting your tax-free savings far beyond that headline number? Let's find out how. Welcome. We're diving into a discussion put together by the experts over at My Tax Accountant, and they're posing a really critical question. Is that £20,000 limit really set in stone? Or are there clever, totally legitimate strategies that could allow you to shelter so much more from the taxman? We're going to explore the options that can make a huge difference to your savings. And you know what? The answer might just surprise you. All right, let's get into it. Here's our game plan. We're going to kick things off with that £20,000 wall. Then we'll unlock 3 powerful keys to get past it: the inheritance gateway, the great migration, and the revolving door. We'll also take a peek at what's coming down the track in 2027 before mapping out your next steps. Right. First things first, let's really set the scene for the 2025/26 tax year. Because honestly, maximizing your tax-free allowance has never, ever been more critical, and I'm about to show you exactly why. Okay, here it is, the number we all know, £20,000. It's the maximum you can pop into an ISA each year. But here's the kicker. That number's been frozen solid until at least 2030. And with inflation doing its thing, that 20 grand buys you less and less each year. It's a sneaky thing called fiscal drag. And trust me, it's quietly nibbling away at your tax-free potential. And, the pressure is really starting to build from all sides. Higher interest rates are great, right? But they're also pushing way more of us over our personal savings allowance. That's just £1,000 of tax-free interest for basic rate taxpayers and a measly £500 for higher rate taxpayers. At the exact same time, the tax-free allowance for your investment gains has been slashed. And this chart? It just says it all, doesn't it? I mean, look at this. Just a couple of years back, you could make over £12,000 in investment gains completely tax-free. Fast forward to the current 2025/26 tax year, and that's been cut to just £3,000. It's a huge drop, and it makes that protective ISA wrapper absolutely non-negotiable. So, the big question, how do we get past that £20,000 wall? Well, our first key is a really powerful but honestly often overlooked allowance. It's available to surviving spouses and civil partners, and it can be a real game changer in what are, of course, the most difficult of circumstances. It's called the Additional Permitted Subscription, or APS for short. So, what is it? Well, put simply, it's an extra, one-off ISA allowance that a surviving spouse or civil partner gets. It's equal to whatever their deceased partner's ISA was worth, and, this is the crucial bit, it's on top of your own 20 grand limit for the year. Now, this is where it gets really interesting. For deaths after April 2018, the way the allowance is calculated is brilliant. You get the higher of 2 figures, the ISA's value when your partner passed away, or its value when the estate is all settled up. So think about what that means. If the investments grow, your allowance grows right along with them. But if they happen to fall in value, no problem. You're protected at that original higher value. It's a fantastic feature. Let's put some real numbers on this. Imagine your partner had worked hard to build up an ISA worth £50,000. Well, thanks to the APS, your personal ISA allowance for that year doesn't just stay at 20 grand. No way. It becomes a massive £70,000. Just think about that. It allows a huge amount of capital to be sheltered from tax, all in a single year, preserving your family's wealth. Okay, now stay with me here, because this is the part that surprises almost everyone, and where most people get it wrong. The APS is an allowance. It's not the actual money. So what does that mean? It means even if your partner willed their ISA funds to, say, their kids, you, the surviving spouse, still get that extra ISA allowance. You'd have to use your own money to fill it, but the power to shelter that extra 50 grand from tax, that's still yours. All right, so that's the inheritance gateway. But what if that's not your situation? What about investments you already have, sitting outside an ISA? Well, our next strategy is a classic, but believe me, it's more important now than ever. It's called Bed and ISA. The strategy itself, incredibly simple, really. The whole goal is to migrate your assets from a taxable account where they're getting hit with dividend tax and capital gains tax into the safe harbor of a stocks and shares ISA. Once they're in there, all future growth is completely tax-free. Now, you can't just drag and drop shares into an ISA. That'd be too easy. So you have to follow this simple 3-step process. Step 1, you sell the investments in your taxable account. Step 2, you move the cash over to your ISA. And step 3, you immediately buy back those very same investments inside the ISA wrapper. I know it sounds like a bit of a fuff, but most investment platforms have made this super easy and you can usually do it with a single instruction. So, you might be asking, why bother with all that? And it all comes back to this one tiny number, £3,000. That is your entire capital gains tax allowance for the 2025-26 tax year. Any profit you make above that, it's getting taxed. So the bed and ISA strategy is your number one tool for managing this. Let's take a look at Chloe, a freelancer in London. She's done pretty well with some shares and now has a £4,000 gain. Now, if she just sold them, she'd pay tax on $1,000 of that gain. But Chloe's smarter than that. She uses the bed and ISA process. She sells the shares, uses her £3,000 tax-free allowance, pays a little bit of tax on that last $1,000, and then, this is the key bit, she moves the full amount into her ISA. From that day forward, every penny of future growth is completely shielded from the taxman. But, and this is important, it's not a completely free lunch. So here's a pro tip for you. There are 3 things you've got to consider. First, like we saw with Chloe, the sale itself can trigger a tax bill. Second, there are transaction costs, dealing charges, and maybe even stamp duty. And third, you will be out of the market for a very short time. It's all about weighing those small, immediate costs against the massive long-term tax savings. Okay, on to our final key, and this one is probably the most useful for the most people. It's all about turning your ISA from a simple savings pot into a seriously powerful, tax-free emergency fund. And it all hinges on one word: flexibility. So, what on earth is a flexible ISA? Well, it's an ISA that lets you take money out and, this is the crucial part, pay it back within the same tax year without using up any more of your £20,000 allowance. Think of it like this. A standard ISA is a one-way street. A flexible ISA, that's a revolving door for your money. This little comparison just makes the difference crystal clear, doesn't it? With a standard ISA, you put your $20,000 in, then have an emergency and take $5,000 out. Tough luck. That allowance is gone. You can't replace it. But with a flexible ISA, you take out that $5,000 and you have right up until the 5th of April to pop it back in. It gives you access to your money without permanently sacrificing that incredibly precious tax-free space. And here's a little did you know for you, because this is where it gets even more powerful. This flexibility doesn't just apply to the money you've put in this year. Oh no. Say you've got an ISA pot of £100,000 that you've built up over many years. With a flexible ISA, you could pull out $30,000 for a house deposit, and as long as you put it back before the tax year ends, you haven't damaged your long-term tax-free savings one bit. Right, time for another pro tip, and honestly, this is a biggie. Not all ISAs are flexible. It's a feature that the provider chooses to offer. It's not a legal requirement. So before you even think about withdrawing any money, planning to replace it later, you absolutely must check with your provider. Ask them, is my ISA flexible? Please, don't get caught out on this one. Okay, so we've covered the strategies you can use right now, but let's look ahead because it's always smart to be aware of what might be coming down the track. There are some major changes proposed for 2027, and understanding them now can help you future-proof your financial plan. So here's the headline proposal. From April 2027, the plan is to slash the amount you can save into a cash ISA each year from £20,000 right down to $12,000 for anyone under the age of 65. It's a pretty big policy shift, and it seems to be aimed at encouraging more of us to invest in things like stocks and shares instead of just letting our money sit in cash. Now, under these proposals, the overall £20,000 limit isn't going anywhere. If you're under 65, you could still save $20,000 in total. But here's the catch. Only a maximum of £12,000 of that could be in cash. The other $8,000 would have to go into a stocks and shares ISA or another type. For those 65 and over, the plan is for everything to stay exactly as it is. Now, you might already be thinking of ways around this, but the proposals are aiming to be one step ahead. They've suggested 2 key rules to shut down potential loopholes. First, you wouldn't be able to transfer money from a stocks and shares ISA back into a cash ISA. And second, they'd bring in a new tax charge if you just left cash sitting around for too long inside a stocks and shares ISA. The message seems pretty clear. They want that money invested. Phew! Okay, so we've explored the landscape, felt the pressures, and unlocked 3 really powerful strategies to get around that £20,000 ISA limit. The big question now is, what do you do with all this knowledge? How do you put it into action? All right, let's do a super quick recap of our 3 keys. First, we had the inheritance key, the APS, which lets you inherit a spouse's ISA allowance. Then there was the migration key, the bed and ISA, all about moving taxable investments into that safe ISA wrapper. And finally, the revolving door key of the flexible ISA, which lets you use your money for emergencies without losing your allowance for good. Look, these strategies are incredibly powerful. They really are. But it's so important to remember that the true master key to all of this is getting personalized professional advice. Your financial situation is totally unique to you. And of course, we have to say that the information in this discussion is for general guidance only. Tax rules are complicated, they can change, and you really shouldn't rely on this exclusively when you're making big financial decisions. So before you act on anything we've talked about, the best thing you can do is consult an expert. For personalized advice on ISAs or any other tax matter, you can get in touch with the specialists at My Tax Accountant. All their details are on your screen right now. And for more great insights like this, make sure you hit that subscribe button on their channel.